When you fully fund a IUL and a whole life, what usually gets more early cash value? Are you selling IULs mainly for cash flow on the back end and growth?
If all I did was do what we teach now, put your money in a life insurance policy, leverage into safe assets, I'd probably have a lot more zeros behind my name.
Why are we making insurance the investment? Like, there's so many other investments out there. Part of me wonders if it's going to blow up in our face. Insurance has a lot of tax benefits to it.
Sure.
So there's benefits of amplifying it because of the tax benefits. I'm like, I don't believe illustrations.
I talk about using assets to pay for your liabilities. And that's just a powerful concept.
If this is so amazing, why aren't the insurance companies doing it with their own money? Why are they still putting their money in treasuries? Like, why aren't the insurance companies using leverage? Didn't Curtis Ray buy like compoundinterest.com or something? He's obsessed with compounding and leverage. And my 2 cents around him is I'm just go on record and say I'm not a fan of how he goes about that. How did you guys get connected? What do you admire about Dave Ramsey and what do you like that he teaches? Dan Thompson, welcome to the makeshift studio in Kona, Hawaii.
Yeah, makeshift is fun, isn't it? Thank you. This will be fun. I'm glad you invited me.
So over 5 years ago, I'm working at Community First Bank as a teller. Just got my life insurance license. I'm trying to learn this whole thing called life insurance. I read your both books because you had 2 books. They looked very similar to like Nelson's, like the bigger books.
Uh-huh.
And you had your number on the back, and I gave you a call. You answered. You talked with me for like 40 minutes. It was a very nice conversation. You were very encouraging, and we never really talked after that. But that conversation was a part of my journey, and we're coming full circle many years after. And I just want to thank you for that.
Oh man, that is awesome. I'm glad to hear it. Glad to know I helped somebody out there.
So I first saw you because of your YouTube videos. You would have like the owl. You remember, like, the owl,
the
like,
wise owl.
Yeah, it was like 10 seconds of disclaimers every video that you would do, and then you would like break it down. And then your son wrote the book. Was it Money, Wealth, and Life Insurance?
Yeah, that's right.
And it was just this short little book, but it was very effective. And I know that you guys have been in this space. So what I would love to do is take a step back, share a little bit of your journey, because you didn't come out of the womb selling life insurance.
No.
And I'm just what I love about you is like you're not just a product guy, but you're like, let's understand how money works. Let's understand how that, and I just picked that up really early on with your content. So I'm going to let you speak about your story, and then we can dive into the fun things that, whether it's life insurance, real estate, all kinds of things when it comes to tax strategies and all.
Oh, great. Yeah. So, it kind of started when I was 15 years old. I was sitting in the back seat of the car with my dad, and he had this buddy. My dad sadly never made any money. He just, more month at the end of than paycheck, right? More month than money. Mm-hmm. But somehow he had a few rich friends. I don't know how this happened, but anyway, I'm sitting in the back seat. I'm listening to him and this guy named Dave, at the time he was 80 years old. So I'm 15. He's long gone, I'm sure.
Rest in peace.
But he said he made $30,000 that month in the stock market. And I'm like, $30,000. I'm 15 years old. I'm working. I'm landscaping houses for $250 an hour. I just run this quick calculation in my head. That would take me 9 years to make $30,000, and he did it in 30 days. So literally from that moment on, I said, somehow, some way, I got to be a stockbroker. And thinking, well, if Dave took the stockbroker's advice, well, then the stockbroker must be even more wealthy than Dave.
Yeah,
because he's the guy who came up with the idea. Well, fast forward, 7, 8 years. I begged a bunch of firms to hire me, and one finally did. They gave me a few tests, said, let's see if you pass our aptitude test. Luckily, I did, and then got my Series 7 and 65 and all that stuff, 63, I guess, at the time, and became a stockbroker. Sadly, realized pretty quickly that most stockbrokers were broke.
Yeah,
and
that's why they're called brokers, right?
Exactly right. And I really tried to make that work. I pushed hard. I did everything. I went to all the trainings and did everything they told me to do. I kind of transitioned fairly quickly into more of a financial planner because just calling up people and saying, hey, you want to buy some stock, it just was tough. But even the traditional financial planning, it was intriguing to me. And I thought, oh, this is going to be great. And I went through a few cycles. My first one was the 1987 Black Monday. And I'm like, well, I didn't know this could happen.
Yeah.
Biggest drop, I think it's still the single biggest one-day drop in history. Anyway, went through that. And then the 94 recession. And then what kind of took me over the top was the dot-com boom and bust. I mean, through the 90s, so easy to make money. Every financial advisor looked like a hero. And then after that, that debacle and the whole dot-com blew up, and then everything else kind of trailed it. I had a guy, good client of mine, he had Parkinson's, and there was no way he could go back to work. And I just felt so bad. And he's like, Dan, we understand. It's the economy. It has nothing to do with you, but put them in a tough financial position. And I just said, no more.
Yeah.
Somehow I got to find a better way. And that's what I did. So for a good 2 years, I was looking at everything. And then I kind of ran across Nelson Nash's book at the time and thought, well, this is at least interesting.
What year was this?
Oh, gosh. 04, 05, something like that. Yeah. Before you were born.
Yeah. Not quite, but close.
Yeah. So, and so I'm looking at this, I'm going, okay, well, this could kind of make sense. And then, so I kind of went that route for a while, but I found out really quickly that just buying stuff and paying your self-interest instead of a bank might be a better way to buy stuff, but you're never going to get wealthy buying cars and RVs and vacations and stuff.
So you were intrigued by Nelson's book, but you're like, you didn't necessarily like the idea of like just being your family bank and like recapturing the interest because you're literally just paying yourself more. And so that was like cool concept, but it kind of stopped there.
Yeah. I'm like, okay, well, what if we paid somebody interest, but made more over here?
Yeah.
I mean, it's going back maybe to the stockbroker days of arbitrage. I'm happy to pay somebody 4, 5, 6% for the use of their money if I can make 8, 10, 12% and make that spread. And that's kind of what I came to conclusion. Like, well, I'm not going to use this for cars, but I'm certainly going to use the concept of using life insurance as my holding facility, my funding vehicle where I store the capital. But then I'm going to use that policy to leverage into other things that would give me wider spreads, cash flow, and some tax advantages.
Yep. So most stockbrokers, when you ask them about life insurance, they kind of roll their eyes. They're like, oh, like it's very interesting. A lot of people that like the stock market hate life insurance. A lot of people that like life insurance hate the stock market. I don't know why that is. I think there's starting to be people that are like, oh, maybe we could use both. For you, what about life insurance in 2020, 24, 25? Like what made that attractive?
Well, I'll tell you, that's really interesting because the truth is that's how I was.
Yeah.
From 86 till the dot-com bust in 2000, basically, I didn't even look at life insurance. I was like, no way. Yeah. I'm a stockbroker.
Yeah.
I don't touch life insurance. That's for those guys. And so I didn't really hardly pay any attention. I'll bet I sold 4 or 5 term policies in the first 10 years. It wasn't until after I kind of, you can actually store your money over here in a tax-free environment, have it safe, and then also have it liquid, and also leave a death benefit in case something prematurely happens to you. And meanwhile, I can double dip. I can use the dollar here, and I can use it here, and eventually I can use it in 1, 2, 3, 4 different places. And so it was just math. It was just logic to say, okay, I got to store my capital somewhere. I'm not going to put it all in the stock market. I'm not going to put it all in real estate. And this way I can have this opportunity fund, I like to call it oftentimes, and just a place where here's my capital, here comes an opportunity. I know where I can get the money.
And you can do that in a high yield savings account, but you just like the idea of life insurance giving your dollars more than one job, like death benefit, tax advantages, better long-term growth. Were those all like the?
Yep. Okay. Wrap it all together, and it's when you look at what life insurance can do and how you can leverage it.
Yep.
I can't find a better asset to at least be the foundational tool for your for your finances.
When did you write your first book?
That probably been around 07 maybe.
Okay, and what was the book title?
The Banking Effect.
The Bank. It was a great title. And I feel like so many people probably read Nelson Nash's book and then probably read your book number 2 because they're
Yes.
like, they're reading his book and they're like, I feel like this guy's brilliant. I just don't fully understand everything that he's saying the first go around. I had to read his book a couple times before it like really clicked, and I know I'm not the only one. And so people read your book. What would be the biggest difference between your writing and Nelson? I mean, a devil's advocate could say Nelson wrote the book. Why did you have to write The Banking Effect?
Yeah, and the Banking Effect had a lot of the Nelson characteristics. It was a few years later when, like my latest book's called The 4 Keys to Building Wealth, when I just kind of put it all together. And I said, okay, look, if I'm trying to build wealth, I've only got 4 things that can help me. Time, which none of us know how much time we have, so don't waste any. Compounding, which is the key to building any kind of wealth, just having $1 turn into 2, 4, 8, 16. Leveraging, wise leverage, I should say, because leverage is kind of a two-edged sword. It'll accelerate the good, but it'll also accelerate the bad. If you're going to go out and, like I had a client who was borrowing money for futures. That didn't turn out so well. And he called me up and said, I got to do something different because my wife's going to kill me. So you got to use wise leverage, and then tax advantages. The single largest bill any of us will ever pay in our lifetime is taxes. So if we can reduce those or eliminate them even, that's a huge wealth builder just right there. So that became my most current and evolving book. So now we've taken it from go buy a car, save interest, pay yourself the interest, to we don't care if we're paying interest to the bank as long as we're making a lot more over here. I would never waste the money I'm paying cash for a car. If a bank's going to give me money over here cheap, and I'm going to take that money that I could have paid cash and go do something more productive with it, that to me is how you really build your wealth.
So let's break this down, because this is a common question we get about when should you use your policy. And people, I've said very publicly, I'm a big fan of the 30-year mortgage. I'm a fan of using banks to finance cars, which people like trigger people all over the place. But my framework is, number one, you have to decide what you want to purchase. A lot of people get enabled to make bad decisions with debt. That's problematic. So figure out what you're going to buy, and then ask the question, what's the most efficient way to do that? I find that some people are using their life insurance to buy liabilities, and they're losing the opportunity to potentially buy another asset, whereas a bank, regardless of what the interest rate is, potentially would give them more control of liquidity. What is your framework when it comes to, if someone says, Dan, how should I be using my policy? Do you have a framework, or is it every case by case?
Hey, it's Caleb Williams here. I'm just interrupting this video quickly to invite you to check out our And Asset Vault. You may have been there. We've actually revamping it. And if you are somebody that wants to learn more about, is life insurance the right fit for me? Does this and asset make sense? Like, does this actually help me be more efficient? We've put together a 10-minute documentary style video that I think does a really, really good job giving the history, why the and asset, different setups and designs that we use. And then we have an and asset vault that gives like case studies, calculators, handbooks, and so much more. We are here to serve you, whether it's a conversation, whether it's education, or the video. So make sure to go check out andasset.com/vault. Learn more.
Well, certainly it's case by case, but anytime I can show them that an asset, income producing and or appreciating and or tax advantaged asset is much better than, oh, you didn't pay interest to the bank because you paid, you borrowed your money for a car. A car is the worst thing on the planet, right? Although you'd laugh at me because I'm kind of a car guy.
Yeah, you are.
I got some fun cars, but I have assets that pay for the cars.
Yes, I understand.
So look, I don't know, pick a car number. Say you're going to pay $100,000 for a car. Well, that's silly to just go put $100,000 into a car and watch it be worth 70, 60, 50, years down the road. Put the $100,000 over to an asset that's cash flowing and producing income. It'll make your car payments and appreciate. And so you're using your money basically much more wisely. Same with a 30-year mortgage. Holy smokes. In fact, I totally lucked out. I refinanced just before interest rates changed again. I mean, I'm an old dude. There's no way I'm going to be paying that thing for 30 years, but I got a 30-year mortgage because I wanted all my equity working for me outside of the sticks and bricks. Here's what people don't understand and what drives me crazy about guys like Dave Ramsey, and that is they think a paid off home, yeah, sure, I get the peace of mind and all that stuff, but it produces no income. It's dead. And the only way you can ever access it is to go get a loan or sell your house. And people can be, you've heard the term house poor. There's two definitions of that. One is you bought too much of a house and you're poor because of the mortgage. The other is time to retire and you're poor in income because all your money's tied up in these sticks and bricks and it can't produce any income for you. So you're much better off taking that extra money that you would normally throw to a mortgage to get it paid off quicker, get it over into a policy, let that policy be your capital fund. Now start looking for other assets. So use the policy as the funding vehicle for everything. And every asset will get better if you've used your life insurance to fund it.
It's good. That's good. Every life insurance is an enhancer.
Yes.
And I think and I would be curious to hear your thoughts. What do you say when people say life insurance is a horrible investment? What is your response to that?
Well, I'd say it depends on obviously it just depends on what you're going to do with it. If you're going to just put in a bunch of premium and get your 5-6% rate of return, I'm probably going to say, yeah, that's not all that exciting. It's safe. And if you die, you're going to be glad you had it, things like that. So there's definitely some protections and guarantees and so forth. But if you use that policy to then get into the other assets that maybe so here's how I say it. Let's say you wanted to buy a rental property and the life insurance guy comes along and says, oh, no, you should buy life insurance. Well, my feeling is don't make that choice. Do both. Get the life insurance, then use the life insurance to get your rental real estate. Then when the tax breaks that you get from borrowing from the policy, you're going to actually increase your rate of return in the real estate. So again, every investment gets better if the funding vehicle's a life insurance policy.
Explain writing off the interest for business use, because that's debatable. Like some CPAs say you need a third-party lender to have it write off. Some CPAs are super content with a lot. So walk down what you actually mean by that, because some people watching this don't even know what we're talking about. And then where do you draw the line of if you're going to write off interest for borrowed loans for business activity? What's your process to make sure that doesn't get audited?
Well, we've been really lucky because for the last 15 years, borrowing from the bank, using your policy as collateral and getting a line of credit from the bank has been cheap interest. It's only been this past year when things kind of got crazy. Well, so we were rarely borrowing from the policy. This is where the CPAs come in. They say, well, if you're going to borrow from the policy, you can't deduct the interest. But if you've got a line of credit from an outside bank,
it's cleaner.
Really clean, because the bank's just using your policy as collateral. And your CPA, the IRS, nobody even needs to know what the collateral is. All they do is see a line of credit. You paid $20,000 in interest or whatever, and that's a deductible expense. Our feeling is if it's for business or an investment purpose, you should be able to deduct it. Most CPAs that we talk to will even deduct it if it's a policy loan. I know mine will, but that, again, you might have a year or two where you're borrowing from the policy while you're waiting for banks to settle down. But as soon as we can get back to using bank lines of credit, we will.
Okay. So let's talk about the four keys. The 4 keys. So you have compounding, you have time, compounding. What's the difference between time and compounding? Because they feel very similar.
Yeah, they are. You have to have time to compound. But without time, you can't compound. So time is just basically saying, look, none of us have a stopwatch on when we're leaving the planet. Right? So don't waste any time. Start absolute today. And then you need the time, obviously, to compound. I like to use the story of the penny doubling every day for 31 days, even though we're not doubling that quickly. The fact is, the last, you're familiar with that story. I don't want to go through all the numbers, but the last compounding period, you go from 5 million to 10 million. And my point is, if he missed that last compounding period, he's out $5 million. If he misses 2, he's out 10 million. I mean, it's just the more compounding periods you miss out on, either through you didn't start or losses.
Yeah.
See, the 2008 crash of the market
Reset a lot of people.
took people 10 years just to get back to where they were in '08.
Yeah.
That's a lost decade.
Yeah.
We can't afford to lose that kind of time and make sure that our money's in a situation where it can be compounding. That's where.
Do you ever feel like compound interest can be used as an excuse, though, to be average, to be like, yeah, I'm going to just I'm going to let the next 30 years, this assets that I don't have control over, do my job? And do you think some people are saying compound interest and not investing in maybe their greatest asset, which is themselves?
Well, so that's a great question. To me, compounding can be in
Any area.
anything. And certainly yourself, for sure. A business that you might invest in that doesn't really feel the growth right at the beginning, but as you work through the business and, marketing and so forth, now all of a sudden it does become a compounding asset. None of us want to invest in anything that goes, down sideways or never makes any money, but yourself, a business, another asset, real estate. I mean, there's tons of places that you can put money to take advantage of compounding.
Okay, let's talk about leverage. I shared like leverage is an amplifier. If you're great at the guitar and you put an amplifier on it, everything gets good. If you suck at the guitar and you amplify it, not good. And that's really the guitar, it represents the asset. Leverage is an amplifier. What is your framework when it comes to leverage? Because I find that people like leverage, but they almost like sometimes it enables them to make some really dumb decisions because their leverage is an amplifier, but the due diligence sometimes doesn't amplify with that. What is your thoughts when people are like leverage? It's like, yeah, I get the math, but the thing that always scares me when people talk about leverage is what are you doing with that, and does that compound? Because one bad decision using leverage could eliminate a lot of compounding years if it's not done properly.
Yeah, you're right. It amplifies the good, it amplifies the bad, and a bad compounding investment compounds the other way.
Yeah.
Right? It just gets worse. So you definitely have to do your homework. You want to make sure you're leveraging into assets and or things that are going to have we all know there's just no 100%, 1,000% guarantee, but let's make sure it's predictable, that it's been around a while, that there's people who've experienced the predictability and the returns and so forth. So I like good, solid real estate.
Mm-hmm.
I actually like equipment leasing because that's a way to leverage and get some tremendous tax advantages. But then we have clients who do e-commerce stores. We have clients who do Bitcoin mining, which is interesting because you're not tied to Bitcoin, but mining is actually kind of safe, if you want to say that, on the crypto side. So there's a lot of things that people can get involved in. And then a lot of them just like to, join in a fund or a group of investors who are buying some apartments or things like that. So, but yeah, you just got to be careful of what you're leveraging. But leverage is literally how most
What's your framework on leverage? So it's like, do you have like, I'll leverage a percentage of my portfolio, or how many times will you leverage times your money, or will you just take as much leverage as you can possibly get and just really do the due diligence on the back end?
If it's the right asset, I'm not too afraid of leverage.
Okay.
If I'm like rolling the dice, there's not going to be much, right? We're going to be very, very cautious. But what most people don't understand is you can leverage a life insurance policy into another one.
Okay.
And then leverage that one into another one.
Let's talk about that, because I mean, that's called laddering, isn't it? And isn't insurance companies isn't that really frowned upon, laddering insurance policies?
If it certainly can be.
Yeah.
But if you've got excess cash value, we don't find too many companies balking at it as long as we're using their money. And it's tech. Because what an insurance company asks you is, where are you getting these funds? Are you borrowing them?
And you say yes.
We say we explain it. We say yes, we're borrowing them. But it's our cash value. And then they're much more comfortable with that. But you'll be surprised what happens when a 5-6% policy leverages, then all of a sudden it's a 7 or 8 leverages into a 9 or 10. I mean, you can, and by the way, you don't even have to leverage into another policy. You can just leverage within the same policy and get your rate of return growing into double digits over a few years.
My question, I want to go back to that laddering policies, which is I understand the point because life insurance is amazing, but if you're borrowing even at 5 or 6% and you're putting it into another life insurance policy, we'll talk about whole life versus IUL in a second. But like where it's hard for me to get my mind around is, Matt, like there's no arbitrage there. You're growing death benefit, you're growing capacity. So it's like you could make the argument, hey, if I have a first world problem in the future and I have a ton of money where I need to stuff it in, I could make the argument that now I have outstanding loans that I can pay in. I just can't get behind the math of laddering policies being good on a cash flow and accumulation side. Maybe I'm not looking at the right policies. I just have never understood how it actually works. And I've always seen it kind of as like a more tacky, slimy practice, if I'm being totally honest.
No, the reality is you do a lot less of that when we're in this environment, when the policy loans are about equal to the internal return of the policy. But when you were able to borrow money from the bank at 2.5-3%, deduct it, now your net cost might be 1.5 or whatever. Now go into a 5% policy, then it makes a lot more sense.
Yes, and you don't get 5% right away. Sometimes, I mean, a lot of these policies are break even at year 4 or 5 or 6 or 7, and so you might be borrowing at 2.5%. So I don't know. I mean, I definitely, premium finance is a huge space, but a lot of people use premium finance for estate planning, and they're independently wealthy. So I just like, and again, if you don't feel comfortable talking about this, we don't. No, but let's talk about Curtis Ray. So let me take a step back. When you first got into business, I feel like you were more whole life driven. I think you even said that in the banking effect.
Yes.
Did you make a switch, or now do you sell both whole life and IUL? Because I guess that's question number one is, what's your thoughts on whole life and IUL? That's a big topic that we have on our channel of the differences. And I love hearing people's paradigms or thought processes around that.
Yeah. So it's funny because one of my most popular videos is why IULs will fail. Yeah. It's got, I don't know, 100,000 views or something like that. And everything in there, the reason why I never took it down is because everything in there is true and accurate. And the reason why IULs fail is because they're never, shouldn't say never, the ones that fail aren't fully funded. So let me give you an example. If you have an IUL and you get your annual premium statement, you might see two numbers. It'll say you only have to pay $1,500, or you could pay up to $10,000. Let's just use those numbers. Well, you might for the first couple of years say, "Oh yeah, I remember my insurance guy told me to max it out, so I'm going to max it out." But inevitably, whether it's 3 years, 5 years, 10 years, somewhere down the road, things are going to be a little tight, and you're going to see that 1,500 versus 10,000, and you're going to put in 1,500. Well, statistically, that is when an IUL is going to fail. If it's not absolutely fully funded every single year, you're taking the chance of lapse.
Because of why? Just because?
Because of the internal costs.
Internal cost, and then do you find...
And the market might not perform that.
And the caps potentially adjusting. And
caps adjusting. I mean, there's 3 or 4 different things that are moving inside of an IUL. So what we did is we hired 2 guys. They came into the office for, about 18 months. And all we asked them to do is go back historically as far as they could. IULs came out about 98, so they went back that far. But then we even said, okay, now let's just pretend they were here back to 1929, I think we went, 28 or something. We said, just follow the market, ups, downs, backwards, sideways, what caps might have done based on interest rates, and just correlate everything as far back as you could. And again, statistically, every IUL that was fully funded did okay.
Yeah.
Some better than, but we always look at it as a 10-year window. There was never a 10-year window that it didn't do fine.
Yeah.
If it was fully funded.
Yeah.
And so when we do an IUL now, what we'll typically do is blend them. Like, let's say a husband and wife want to put in $50,000. We'll do a $25,000 premium on her, usually in the IUL because she's going to live longer, $25,000 premium with him in a whole life. And the blend is really kind of sweet because
it's like a volatility buffer, built-in volatility buffer.
So if the IUL does have a bad year, the whole life makes enough to truly make it a 0 year instead of a zero minus cost, right?
When you fully fund a IUL and a whole life, what usually gets more early cash value?
The whole life.
Okay, so whole life, when's usually if everything works out properly, are you selling IULs mainly for cash flow on the back end and growth?
Yeah,
potential?
and we want to leverage them as well. So so we'll but that blend just makes it kind of nice. And then there's both IUL companies and whole life companies have a way to enhance the cash value in the first years. There's some riders that you can add and so forth. And then some of the IULs have these base fixed loan rates at 3.25. So we really do get that arbitrage even kind of right out of the gate. So anyway, all told, it took a while.
Yeah.
I mean, these guys had to come to me with spreadsheets and proof. And then the guy who I work with really closely, who's just a numbers geek, he just nerds out on numbers and spreadsheets. And I literally watched these guys for months in the office before I finally said, okay. And then I'm always the first guy in the pool. I'm never going to let somebody invest in something that I wouldn't do for myself. So I got my first IUL several years ago. And
how many years ago?
Oh, gosh. It's probably been 5 years now.
And so has it broken even yet?
Well, it does for us, right?
Okay.
Because of the way we're
structuring it,
doing it.
Okay.
But most people, you got to still figure it's a 5 to 7 year break even for both whole life and IUL.
Okay.
But anyway, so I dove in, and now I have I think I have 4 of them now.
Okay.
So
you doing the whole like laddering on your side, building capacity. I mean,
absolutely.
Hey, if you have when you have more money at the end. Because is that the game plan, is to cash out something, sell a property, and backfill? Because
eventually, but I don't think you don't really need to do that. If you've got the policy, at least with some small arbitrage, it'll produce cash and income even without paying back all the.
So loans. What I love about you is we can have candid conversations. let me share devil's advocate with you. I don't like the idea of having an insurance product which is supposed to be safe, foundational, and making it make it an investment. Like I just feel like with all the things that we know, all the assets, our business, all these other things, that's where I just am like, okay, yes, in a perfect world, I get it. Like you put money into an IUL, things do well. You are able to borrow at a lower rate. You're making more long term. So long term, if I can make 7 and borrow 5 and keep doing that, like that's a quote unquote brilliant on paper. Part of my skepticism is like, is that actually going to happen? And then part of me goes, why are we making insurance the investment? Like there's so many other investments out there. Part of me wonders if it's going to blow up in our face. So that's where I've always been hesitant. That's where, again, I'm not like it's like I understand the pitch of IUL. I've just been pretty consistent that life insurance is like foundational for me. Safe, foundational protection. I want to use it to amplify other assets, but I don't want to use like my safest sacred asset and create potential upside, but take on extra risk, because I want the foundation of my house to be foundation,
solid.
not the sexy thing that everyone's thinking. Yeah. So what is because obviously insurance has a lot of tax benefits to it. Sure. So there's benefits of amplifying it because of the tax benefits. I'm like, I don't believe illustrations. That's just like, I'm like, they are lying to us and it looks amazing. But I've seen even in my short career, I've seen so many companies and people on the whole life and IUL side, like they'll do anything to like get us to sell for them. But then there's just like, is this going to work 30 years from now? And if this is so amazing, why aren't the insurance companies doing it with their own money? Why are they still doing putting their money in treasuries? Like, why aren't the insurance companies using leverage? So those are just some devil's advocate
and those are great. And I think the difference is, at least with us, is we're not selling it as an investment, because the investment that's outside of policies. And the reality is most IULs aren't going to perform more than a half, maybe 3/4, maybe 1% higher than a whole life when it's all said and done, if you stretch it out. So we're not selling it because, you get it really is sold just for the protection of the interest rate that we can borrow at.
Yep.
And when we run our projections, so we get the insurance company's illustrations, we throw them into our software, and then we pull off about 1.5 points.
Yeah.
And we just say, we're going to dumb this down to where all we want is a 1% arbitrage between borrowing and crediting. So if the IUL will do 4.5, and we can borrow at 3,
right.
That's all we.
So, and what you're saying is you'll do that a couple times, and then you still have cash value to go invest in other assets.
Yeah. And let the other assets build your wealth.
So why don't you just do that 100 times? And then, and it's like, when do you decide to stop? It's like, you know what I'm saying? Like, I know I'm pushing you on this. I'm just like, it's just one of those things where this is where it mathematically, it's hard for me to get behind, because it's like, I just feel like it's great until it's not.
Well, here's the
we
problem.
might have to have a part 2 where you show your computer. This will be amazing.
Oh, yeah.
I would love. Our audience will eat this up.
Yeah,
they will.
You really would. I'd love to show you how we do the spreadsheets.
Let us know in the comments if you want part 2. And
So one thing let me go devil's advocate the other way.
Yeah, please do. Please do.
I unfortunately sold some whole lives with companies who did nothing but lower their IRR every year, and didn't even have a chance. Like. I get caps can change and stuff in an IUL, but I still have a little bit of a hope in a good year that it's going to be a good year. One of the first companies I worked with, in fact, one that Nelson pushed heavily, their IRR is like 1.2%. No way you could leverage it. No way you could borrow. And it just doesn't make any sense. So as much as I get what you're saying on the IUL side, there's been enough on the whole life side that you got to be cautious.
Totally.
I mean, seriously, we're down to like 1, maybe 2 whole life companies we'll even look at because of their past performance.
Yeah.
Same with IULs. There's plenty of them we won't even touch. And that's why we needed these guys to you go crunch XYZ company and ABC company, and you go get their historicals, and you just make sure that this company would have at least met their obligations within any 10-year period of time going back to and so that's kind of what took me over the edge and convinced me. But you'd love to see these spreadsheets.
Yeah, no, and it's less about the IUL. I have great friends who, and people ask me about my stance, and I have stance, but I'm not going to freak out. Like, if someone understands that there's pros and cons and they want to go the IUL route, awesome. I just am very clear, like, now it's less safe. I think we both could agree on that. But there's potential more upside. Yeah. Where what I would love to do part 2 on is understanding why borrowing and then funding more life insurance is a good idea.
Yeah.
That's where I would like to go deeper, because on the whole life and IUL side, I feel like, and maybe I'm just the traditional young kid that doesn't, I just don't get it. So
we did 2 things to help as well, and that is we got connected with a bank who will actually help. I call it the bridge loan, right? Yeah. Let's say you're going along and you've been putting in $50,000 a year in premium for 2, 3, 4 years. Something happens, lose your job, can't do it. We have an outside bank that will actually loan you the money to pay your premium, so that, again, the worst thing that can happen in any whole life or IUL is it's not fully funded. Yeah. So we got to get that thing fully funded. Yeah. So we know that this is going to get fully funded every single year. Yep. And that helps us justify, because if somebody calls us up and says, hey, my IUL, notice came and I'm only going to pay the minimum.
Yeah, you're
no,
like, yeah.
We're going to go over here. We're going to get you some money. We're going to make sure that thing gets fully funded every single year.
Yeah.
And then that helps because that takes some weight off our shoulders that it's going to lapse because of
and if you have multiple policies, you fully fund this one, and then you take a loan and fully fund this one. And so it's like, but if you don't fully fund, then it could be problematic.
House of cards. Yeah.
What's funny is we'll switch subjects a little bit. So I remember watching your video about IUL, like the doubt, and I was like, yes, Dan, yes. And then I see you write the foreword to Curtis Ray, his book.
Yeah.
And I almost fell out of my chair when I saw that. I was like, I'm just wondering and did Curtis make you a believer in IULs? And so you don't have to go into details, but like Curtis Ray does something similar with MPI. I feel the same way about what I'm talking to you.
Sure.
I have a lot of things that I'm
not comfortable
with.
Sure.
I'm just speaking for myself.
And
so, but I know that you're a big fan of leverage and compounding, and didn't Curtis Ray buy like compoundinterest.com or something? He's obsessed with compounding and leverage. And my 2 cents around him is he's talking about great points. Compound interest is amazing. Leverage is amazing. Mm-hmm. I'm just go on record and say I'm not a fan of how he goes about that. How did you guys get connected? Because obviously you writing the foreword, you're a big deal in the space. And so you writing the foreword, I feel like is a huge win for him. Thoughts, reflections, and then we'll move on to Dave Ramsey after that. So
I really like Curtis. I actually think he's got everything in his heart to do things right.
Yeah, I agree with that, by the way. I think he's very passionate, loves people. I think he's wrong, but
that's okay.
But I think he has a true heart to serve people.
Yes. Yeah, and honestly, he hit me just at the same time that we were working with these,
that's hilarious.
These guys, and they were showing me day in and day out, Dan, this can work if you do this, and then so Curtis, we talked, and I flew down there, and he flew up here, and we kind of just, I was this close to working with him, much more closely. But I still had this whole life feeling that you had to have whole life. Where 20 years ago, you'd hear me say, no, don't even touch IUL. Yeah. It took a while for me to, and
that's humility, by the way. Humility is when you're able to say, hey, my most popular video was this, and I'm willing to say I have changed my opinion, and I appreciate and respect people that aren't stuck in their lane. We're going to talk about Dave Ramsey in a second. I feel like he's stuck in his lane and he's benefited from it, but I also am like,
it's in his way now.
I feel like that. So I admire that.
And you're exactly right. I have a video out there that says if the worst financial advisor you can ever have is one that isn't willing to learn.
Yeah.
And the Dave Ramseys of the world, you can't teach him anything. He knows it all, right?
Yep.
And that's where it was a little with Curtis a little bit because he wasn't willing to look at even at whole life and how the blend would work and so forth. So anyway, good guy. I read him. I wrote the foreword in his book. I don't have any regrets doing that.
Okay.
But and we talk every once in a while still.
Great.
But he knows that at the very least I'm going to blend and have both whole life and
good for him to have you because you're that he went out on a ledge and had someone that's not like an IUL purist through and through. And so I think that's great. He's iconic on TikTok. And, I think he's helping a lot of people wake up to the power of compound interest. So that's in everything. And we'll transition over to Dave Ramsey. Dave Ramsey's, I don't think he at this point cares about learning. He's just he has more to lose if he changes his opinion on something. And to his credit, I think he needs to stay in his lane because there's a lot of people that he teaches that need to cut up their credit cards. Leverage is the last thing that they should do because their life isn't working. And so leverage is going to amplify a non-working life. This will be a fun little question. What do you admire about Dave Ramsey and what do you like that he teaches?
Well, the reality is his clientele is typically not mine, right? I mean, he's helping people who, I gotta go buy McDonald's and the only way they can buy it is with a credit card. Come on. And I think that's great. If he can help people manage their money and stay out of debt and all that. So I admire that. I think that's his place. It's when he goes to the next step, where the investment side of Dave Ramsey, I think, is just way out there.
Yeah. 12% mutual funds.
Yeah. And the fact that he just despises life insurance. Yeah. And I can tell he doesn't understand it just by his comments.
Yeah. They steal the cash value. Yeah.
They keep the cash value when you die. Well, where does the death benefit magically appear? I mean, part of that death benefit, the insurance company, of course, is going to use their cash.
Well, and just to be clear on both IUL and whole life, when you're fully funding it, if you're overfunding it properly, the death benefit will increase every year. So is it true that you don't get your cash value and death benefit? Yes. Is it also true that the death benefit grows faster than your cash value grows? Yes. So in other words, you're technically right, Dave, but you're not admitting that the death benefit is growing faster than your cash value is growing. And so it's essentially saying you get death benefit plus more whenever you pass away. And so those are the little comments that I go, I can't believe that's the thing that people are arguing with me on YouTube. It's like I'm like, can you please get a better point,
argument,
because it's not effective.
Well, the way I look at it is, say I got $1 million death benefit and $200,000 of cash value.
Yeah.
Okay. I die. My wife gets $1 million. Does she care that the $200,000 was part of that, or did they go take it and run over to the Bahamas with that $200,000, and they pulled another $200,000 from the other side to pay the $1 million?
Yeah,
it's $1 million, and what you're truly doing in whole life is you're only paying for $800,000 of death benefit, not $1 million, because 200 of it's yours. I mean, it's semantics, and when it comes right down to it. But the reality is, he's using that as a scare tactic instead of just being straight up. And I love to call all those guys that work with him his minions. So I'll do a video talking about his minions, and I just did one just a little while ago. He did this great job of explaining compounding, and then he went and talked about paying off your house in 15 years. I'm like, that's not compounding.
Yeah.
It's just, so he does great, get him out of debt, but then let us take it from there.
Yeah. Well, and it's funny, if you use Dave's logic, 12% mutual funds, and then you also use his logic, pay off your house, you're like, okay, let's run the math here. Like with Dave's advice, we just lost millions of dollars.
Millions.
And again, I have a ton of I have probably way more respect than people realize about Dave Ramsey. Like he would be like my number one person that I would interview if I could.
Sure.
And I just would have so many questions about, some of the things that we disagree, but I just admire what he's built. And the reality is he's impacting a lot more people than we are because he's stayed consistent. He's actually he's doing what we're doing from a standpoint of investing in his business, all those things. He might have millions and millions of dollars in mutual funds. His payroll per month is a lot, maybe more than what his entire mutual fund net worth is. I don't know. This is all speculating, but what I'm saying is he's where he is because of his business. Business, and that's a huge message that you and I both have, is produce in assets, and you being your greatest asset.
Well, it's easy when a guy's making that kind of money and he's getting all the money from sponsors and advertisers, and he does very well. It's easier for him to say, go pay cash for a piece of rental property or whatever. But the average guy out there making $150,000, $200,000 a year, it's going to take him 20 years to save enough to go buy that property, and that property's appreciated 3 times since then. And you'd be better off leveraging that property, get it under your control, take the appreciation and the tax deductions. Yeah. That's how you build your wealth.
Question for you: what are some of the biggest mistakes people make in the insurance space, or just in general in finance? Like, what are some of the things that you just sort of like, don't make this mistake?
Rolling the dice on some investment that sounds. Look, there's some really good investment that still sound too good to be true. Yeah. But you got to do your homework, make sure that it's sound. But really the big thing that I see is people, I'll give you a great example. We leverage life insurance. And we tell our clients, be very careful, Yeah. I had a client who thought he could pick the next coin that was going to come out in crypto, and leveraged his life insurance policy, went and bought the crypto. Didn't work out. We have literally for the last 4 years just scrambling to keep those policies alive because he didn't have the capital to replace that that loan. And luckily we have the capacity and the knowledge and understanding, and we can like I say, we've been inking it along, but that's the worst thing. You just can't you can't roll the dice when you're leveraging a policy. You want to be very conservative.
What are you excited about in the future? Like, I know you're someone that's full of energy. You're like playing basketball. Like I'm doing breath work in the morning, and you're like walking, running up and down the beach. And I'm like, man, you're in good shape. I can tell you're full of life. What are you excited for when you look at the future?
Oh man, I'll tell you, I've got so many good investments that I just want to see them go to fruition. Like this year, or I guess last year now, I bought a student housing complex at Texas A&M, and I just want to see that explode. And just and then I got 19 grandkids.
That's amazing.
So it's fun. We when we get together, I'll sit the older ones that can kind of understand, and I've talked to them about the penny doubling and the frog that gets in the whipped cream. And, I mean, just fun little stories, but I'm always telling them, look, think.
I'm not familiar with the frog that got in the whipped cream.
Oh yeah, so two frogs get into this barn. They get into a pail of whipped cream, and they realize they can't get out. And so the one says, "Oh man, there's no hope," and just goes to the bottom and drowns. The other one keeps kicking and kicking and saying, "Okay, there's got to be a way. There's got to be a way. Got to be a way." And he just keeps working at it, thinking. And then finally he says, "I don't think I can make it either." And he stops, but the cream is turned into whipped cream, butter, whatever. And now he can climb out.
Wow.
And the whole point is, compounding, whatever you want to use as your analogy. Don't quit. Don't stop. Just keep going. You just never know what's at the other end of the tunnel, so to speak.
Any final thoughts that you have? Just anything else that you want to share with our audience, or what you were up to?
I wish I would have somehow, some way, back in 1986, learned these concepts.
Powerful.
I mean, I've been doing this 38, 39 years. And if all I did, because I've lost money, right? Stock market, all that stuff. If all I did was do what we teach now, put your money in a life insurance policy, leverage into safe assets, I'd probably have a lot more zeros behind my name. I mean, I'm lucky. I've done well. But just that little change in my life would have just put me that much further ahead.
Last question I end on the show is the legacy question, which will be fun. 19 grandchildren. This will be a fun one. If this was your last day on Earth and you couldn't give your kids or your loved ones any books, any videos, you just had one last conversation with them, what would you say? What would you say to them?
Well, here's my book.
No, you can't give them your book.
Oh, not.
Yeah, you just have a conversation. What are you covering?
I would talk about using assets to pay for your liabilities, and that's just a powerful concept. That Rich Dad Poor Dad.
Yeah.
That would be the recommended first book.
Yeah.
If I could do that, and then I would tell them, don't ever think about getting a job. Think about how you can improve other people's lives, and you'll be on your way.
It's a nugget. Dan, thank you. Thank you for making this happen. We're 5 years in the making. Thank you. And I'm grateful to know you.
Oh, thank you. And it's been fun. And let's do part 2 with some spreadsheets.
That's right. Yeah.